Good morning and welcome. I'm Ferdinand Zeeman, Head of Financial Services for KPMG in the Netherlands and your host today. This is the first in a series of webcasts for banks on how to navigate the business challenges of COVID-19. Of course, our priority at KPMG, and I'm sure for everyone on the call, is the health and well-being of people. Our people, our clients' people, their families, and the communities we all live in. At the same time, we want to stay in touch with our clients. This webinar series is one of our initiatives to support our clients. We want to share practical information and steps for you to consider in the short and medium term. Please let me share some practical information. We will run through a number of topics and then return to the Q&A at the end. As the presenters are joining us remotely today, and this is not our usual way of communication, please bear with us. During the webcast, you can type in questions in the chat box, and we will try to address these during the Q&A. If you have any follow-up questions from today's session, you can reach out to any one of us directly. And finally, the recording of the webcast will be available on the KPMG website. Today, I'm joined by two of my esteemed colleagues from the Netherlands, Lennart de Vries and Dick Korf. They are experienced partners, active in banking, and they will also introduce themselves to you once we get to their respective sections. As you can see from this agenda, Lennart will first spend some time discussing how we see most banks organizing their activities in direct response to COVID-19. Later on in the presentation, he will highlight where we expect focus to shift from banks once we return to some level of normality as a society. In many conversations, our clients indicate that the way financial reporting performance will be affected by COVID-19 is a key theme for them. Dick is one of our senior accountants and active in accounting advisory. He will be sharing some insights into this particular topic. And I'm also pleased that we are joined today by my colleague Henning Dankenbrink, who is the partner that leads our KPMG ECD office in Frankfurt and who collaborates with us in the Netherlands and across Europe more broadly on a number of prudential and supervisory initiatives. We intend to go through the information in today's session in 45 minutes so that we will have sufficient time for the Q&A. In the Netherlands, we are now in the 6th week of working from home for most people and adhering to social distancing. And as you would expect, much attention is focused on trying to control this health crisis. But more and more attention is starting to shift to the economic consequence, especially in countries where unemployment is hit hard. For banks, the impact of COVID-19 is profound and very complex in nature. Historically, pandemics have been part of the stress scenarios banks are taking into consideration, but the current situation is unprecedented, remains unpredictable, and is fraught with many uncertainties. The immediate response to the crisis of banks rightfully has been focused on the well-being of their employees, keeping the business running, and by actively helping vulnerable client groups. Applying scalable technology has been and will be a key feature in dealing with these objectives. We would have been in an even worse situation should this crisis have emerged only a decade ago. Nevertheless, today's situation is presenting banking institutions with immediate and multifaceted challenges. Think about areas like liquidity management, credit risk management, and market risk, but also enterprise risk management, non-financial risk management, and reporting are impacted. And as most banks have announced support measures for vulnerable client groups, naturally, the client-facing parts of the banks are also under a lot of pressure. They are dealing with the operational and compliance challenge to timely provide the right clients with these amended terms or access to government-initiated support programs. Obviously, for those banks dealing in multiple countries, the complexity quickly increases as the lockdown situation or response to COVID-19 varies country by country. Governments, prudential and supervisory authorities have all responded quickly to the crisis by lowering capital requirements, extending deadlines, or postponing implementation of new regulations, and by providing guidance on which economic scenarios to use when calculating loan loss provisions. However, as Henning and Dick will discuss, there is still a lot of uncertainty on how to practically apply some of this guidance. And as you will hear from Leonard, most banks have focused their resources on a number of themes to respond to the immediate impact of COVID-19. Nevertheless, we also see that in the last few weeks, the focus is starting to shift to the return to business as usual, and when and what that new normal will look like. Later on in the presentation, we will comment on where we expect banks to focus once we actually get to that stage. I will now pass over to our first expert of today, Henning Dankenbrink. Henning, could you please give us an overview of the European regulatory measurements in relation to the key risks for banks?
Sure, Ferdinand, thank you. Happy to do. It's really my pleasure to join the webcast today. Well, let me start by saying that there really have been several publications from several authorities on different topics over the last weeks. To structure my presentation, I'm going to map them to the key clusters of activities in banks and share with you our observation on general intent and how banks are implementing things. The aim of my presentation is to give you a good overview and to point out the key lessons learned so far from our discussions with banks across Europe. My aim is not so much to be really comprehensive and walk you through every single publication. Instead, I'm aiming to put things into perspective. The clusters of activities in banks are business continuity, liquidity risk management, credit risk management, and capital management. At the end of my presentation, I will give you an outlook on further relief actions of regulators and supervisors that we expect are in the pipeline. Should you have joined our session online today, you will see on the screen the focus areas of banks on the left-hand side, and let me go through them one by one. First of all, many banks have in one way or another set up a PMO or command center for COVID-19. It brings together different activities to manage implications of the crisis and to ensure business continuity. As an example, the well-being of people has to be ensured. Many work from home, not only in your organizations, as you've just heard, but also in KPMG. And in some key areas of the banks, teams are being separated. At the same time, the infrastructure has to work properly, internally and externally. As one of my contacts in Europe has put it, we would never have run a test scenario where 50% of our people work from home and we receive way above average number of client requests. This is very extraordinary. Leonard will explain in more details how the business continuity management works in practice. Now, you might ask, what have regulators or supervisors done to support business continuity management? Well, first of all, the supervisors do acknowledge that the crisis requires proper management attention and absorbs human resources. Simply to minimize other tasks, supervisors have postponed some activities. To give you an example, most prominently, the stress test exercise has been moved to 2021. On-site inspections have been delayed and supervisory decisions have been postponed. Also, remediation work has been extended by 6 months. Same applies for certain deadlines that the ECB has implemented. And last but not least, also reporting obligations have been reduced or deadlines extended. Therefore, in a nutshell, from the perspective of supervisors and regulators, actually they have done quite a bit in order to support banks. Well, one of the questions that I'm receiving from European banks is whether this 6 months grace period that the ECB offered would be extended simply because deadlines still fall into the current year. And the question is that going to be moved forward into the next year? That is an area that remains to be seen. So therefore, to close the chapter of business continuity management, we do see quite a bit of activities from supervisors simply to reduce the operational burden and to allow banks to focus on COVID-19 activities. Now, let us move on to the other key clusters of activities in European banks. And on the slide, you can see the next point we'd like to look at is liquidity risk. With regards to liquidity risk, actually, we do see very different implications of the COVID-19 pandemic in different European banks. It really matters what the portfolio looks like. Should banks have a significant corporate lending business, well, then they are experiencing typically that numerous debtors are drawing their credit facilities. This has immediate implications for liquidity management. At the same time, we do see that retail clients are starting to use payment holidays. In the US, we are seeing that commercial real estate tenants are not paying rents or other tenants are not paying their rents as required, which again has implications for payments to loans that banks have issued. Clearly, looking at it from a materiality perspective for now, the corporate portfolio implications, that is the topic that is of most concern, looking at the materiality of how credit facilities are being drawn. Let me also mention with regard to liquidity risk that the reporting that we have developed, that relies typically on KPIs and KRIs that are developed with regards to stress tests and good times for liquidity management. These stress tests do typically not represent anymore the expected developments for the next days and weeks. Therefore, we are seeing that European banks are revisiting their liquidity risk management framework to allow for more tailor-made KPIs and KRIs that are needed in this situation. Now, you may ask, all good, but what have supervisors done to support banks in liquidity risk? Well, I mean, if you look on the right-hand side of the slide, there are a couple of measures to note. The most important one is the publication from the ECB on the 7th of April. The ECB has announced that they are easing their collateral requirements and that banks are allowed to submit less quality of collateral. However, the devil is with the details, as so often. This ruling is being implemented by national central banks. Therefore, we are seeing differences across Europe regarding the degree to which this publication and this new policy of the ECB is really helpful. In addition, apart from that publication on the 7th of April regarding collateral easing measures, banks are allowed to operate below the minimum liquidity coverage ratio of 100. However, also here, should banks, there is a bit of a side note, should banks fall below this number, they will have to submit restoration plans. And it seems to us that the ECB has very frequent calls with a number of banks to understand latest developments. Another measure the ECB has taken is the Pandemic Emergency Purchase Program. This is aiming at high-quality liquid assets and therefore not really the measure that has helped so terribly much in this situation. So to summarize, liquidity risk is very high on many banks' COVID-19 agenda. Depending on the characteristics of the portfolio and drawdown of credit facilities, margin calls, payment holidays, and so on, there are immediate managing actions required. Reporting needs to be adjusted. Models and parameters are being amended. Supervisory measures are certainly important. They have helped, especially the collateral easing measures. However, the degree of help varies across Europe. Now, after discussing business continuity and liquidity risk management, let's move on and take a look at credit risk. As Ferdinand has already mentioned, clearly credit risk is very high on banks' COVID-19 agenda, and banks are looking into portfolios, either what has happened already or what is going to happen. Due to lockdowns, factory closures, significant macroeconomic downturn, corporate portfolios are starting to suffer from a significant number of downgrades already. Residential mortgages are starting to show signs of payment holidays. However, clearly, as we all know, retail portfolios will most likely be affected later this year or next year once unemployment starts to rise. We are seeing this in the US, unfortunately, already taking place. However, in Europe, that is down the road. Again, with regards to credit risk, regulators and supervisors have published a number of documents. I would say most of the documents that you can see on the slides on the right-hand side are one way or another related to credit risk. They provide guidance, particularly regarding government support, forbearance, payment holidays, unlikeliness to pay triggers, as well as potential procyclicality of IFRS 9. Dick will go a bit more into the details of the implications for IFRS 9, but let me already point out that irrespectively of all the guidance and government and regulators measures, the CRR and IFRS 9 still apply. I think that is really a key lesson and a key aspect to note. Credit assessments have to be updated, and banks have to look into that. Rating downgrades, irrespective of all measures, still happen, and significant increase in credit risk is also likely to occur, even though forward-looking information may be used as a mitigant. We are very early in the credit cycle, so therefore there will be more deterioration down the road, and banks will have to look into case by case what is a viable and sustainable business case of a debtor and which is not. At this very early stage, the feedback from banks across Europe that we are getting with regards to Q1 provisions is that these provisions tend to be lower than without the guidance granted by regulators and supervisors. However, banks are also saying that whatever measure banks are taking and which way ever they are implementing forward-looking information, amending models, the auditors need to agree to these interpretation model changes and assume forward-looking information. So let me summarize. Although regulators and supervisors have published a number of documents, credit risk assessment still has to be updated, and loans may need to be restructured to the benefit of the debtor, which means forbearance has to be tested. And, behind the background of all these developments, a significant increase in credit risk might occur, which would lead to a stage transfer according to IFRS 9. Therefore, we will see a rise in provisions over the remaining year. That is pretty certain. And as I said, Dick Hoff will walk you through more of the details in that regard. However, it's not only credit risk that is clearly affected by COVID-19, but also market risk. Market volatility has increased, bid-ask spreads have widened. Therefore, banks with trading books are likely to see a significant increase in market risk RWAs, and they are also likely to see valued risk outliers. The ECB and also the Bank of England, they have provided temporary relief for capital requirements in a certain way. However, that is only applicable for banks with internal models. Therefore, with regards to market risk, for most banks, actually not much of a difference to the world without the COVID-19 guidance. Now, I hope you're still with me. Let's move on to the final cluster of activities that I would like to cover today, and that is capital management. This is a very easy aspect from the perspective of reviewing ECB guidance and other authorities' guidance, because undisputedly what has been done are really very significant actions from our perspective. Pillar 2 requirements have been reduced. We estimate that on average, the different measures that the ECB and other authorities have taken lead to a reduction in CET1 capital requirements by about 520 basis points for banks directly supervised by the ECB and domestically significant. Basel III will be implemented a year later, and there is discussions whether Basel IV should be postponed as well. However, one of the key questions that I'm getting from banks across Europe is, all good, but what are the rating agencies going to do, and how are they going to look at all the measures taken by banks? So to summarize, and let me come to the end of my presentation, the regulators and supervisors have taken significant measures to provide operational capacity, to provide liquidity, and to provide capital for banks. And there is significant response from supervisors. However, if you look into them one by one and in detail, clearly there is differences across Europe, and it depends very much on portfolios of the banks. Therefore, we believe the measures for capital, they are most significant. In credit risk, yes, they are helpful, but CRR and IFRS 9 still apply. For market risk, it helps banks with internal models, and therefore we do believe that particularly the capital measures are the ones of highest impact. Looking ahead, and that's the final paragraph of the final section of my presentation. Looking ahead, we do expect further guidance from the ECB on the supervisory review and evaluation program for 2020. And actually, we are also expecting more guidance on non-performing loans. There are publications of the ECB. However, what is still outstanding is guidance on the prudential provisioning calendar, and we might see something in that area going forward. So that is what I wanted to share with you, and I now hand back to Ferdinand.
Thanks very much, Henning. That was very comprehensive. Thank you for that. I would like to hand over to Leonard now, who is going to discuss how COVID-19 is impacting on operational resilience at banks.
Thank you, Ferdinand, and good morning to everyone. My name is Leonard de Vries, responsible for banking within the Strategy and Operations Department of KPMG. And today I'm going to talk about operational resilience and later on provide you with some post-COVID-19 considerations. Now, let me start with operational resilience. And let's define operational resilience as the ability to withstand operational shocks and continue to deliver on your core business. As KPMG, we divided operational resilience into various building blocks. These building blocks are protecting the workforce, maintain vital services, support our customers, protect the balance sheet, and maintain high standards. I would like to touch upon the first three in the next couple of minutes. To start with the first building block, protecting the workforce. Most banks have either followed local government measures or have been even more stringent in terms of well-being, social distancing, and working from home. To protect the workforce, we have seen banks focus on two areas. First of which is compassion. Banks have considered the impact of COVID-19 on individuals and families, the stress of working from home and being cut off from fellow team members, can compromise physical and mental well-being. They have communicated that personal health is the top priority and have provided clear guidelines on how to stay fit when working from home. Some have facilitated healthy and safe working conditions by ensuring the basics in terms of chairs, network connectivity, bandwidth, IT support, and monitors are taken care of. The other key topic is leadership. We believe that the leadership you demonstrate now will determine your relationship with your clients and employees after the crisis. It is important to be clear, transparent, and consistent in your communication. As a leader, you have the key tools to support your people in this crisis, namely empathy, curiosity, resilience, and humility. For more information on the challenges and possibilities of leadership, you can view the webcast of René de Beau, our People and Change partner. Let me move on to the second key building block, maintaining vital services. Some of the banks I have spoken to asked, how can we ensure continuity of critical activities when society is moving towards a lockdown? In my experience to date, what to do falls in three areas. First of all, the execution of business continuity plans, to the extent they were appropriate. And secondly, being creative and quick to respond to maintain critical functions in the present situation. We have seen, where appropriate, an upskilling and redeploying of teams to accommodate the steep increase in critical business lines and services, such as call centers, and increasingly more on the forbearance and non-performing exposure management areas. Some banks have split their workforce into A and B groups, while others based it on levels of criticality. Some banks have reduced working hours for employees with children at home. And finally, banks should identify and remedy issues preventing efficient and effective remote working, such as staff not having the necessary technology access. Now, on a positive note, and Henning already mentioned it earlier, how could you have planned for an experiment of 50% of staff working from home while maintaining 90% of your capability? So you should also look at what you can do as a bank in this experiment. Let's move on to the third key building block, supporting our customers. We have seen banks increase customer support in two main areas. The first area is the immediate credit reviews, classifications, and remediation. Banks are currently being overwhelmed with credit applications and moratorium requests, whilst many branch offices are closed. This requires new ways to communicate with customers in an efficient yet empathic way. Also, it requires the ability to derive standardized measures to accelerate cases where possible, whilst providing support to customers under increased pressure. There's a strong need to establish a consistent application, meaning a portfolio approach checked by all three lines of defense to ensure a proper audit trail and to mitigate potential future litigation. Banks should finally be able to deal with the significant data challenges in distinguishing between SMEs that were in trouble before the crisis and healthy SMEs impacted by the crisis. Now, the second key area is in the attention of longer-term strategy in the light of relief programs. Banks will critically have to evaluate their client strategies on three different levels. On the level of products, we see, for example, for which payment holidays were granted, it should be clear how this ensures compliance with existing forbearance policies or whether waivers should be requested. Also, how should banks deal with tax payment deferrals for 3 months or maybe even longer? These and other are relevant questions banks should need to address on the product side. On a sector level, banks should consider the repercussions of the compensation by governments to specific sectors, especially affected by the outbreak. In the Netherlands, for example, the guarantee instrument for the flower industry. And on a geographical level, different countries will respond in different ways with respect to economic relief programs. Bear in mind how to cater your approach to clients in various geographical markets and keep up to date with the latest measures per country. And as Henning already mentioned, how to deal with collateral easing measures that differ per country. We have an overview of the most important measures per country upon request. The fourth building block of operational resilience is protecting the balance sheet. This revolves around solutions in credit risk management and actions related to capital and liquidity. Henning already elaborated on this, and my colleague Dick will take it further. The fifth building block of operational resilience, meeting high standards around risk, reporting, and regulatory obligations, have previously been discussed by Henning as well. So I would like to leave it with that. Let us now move on to the next agenda item. Ferdinand, back to you, please.
Thanks, Leonard. Now, one of the areas you mentioned was protecting the balance sheet. Obviously, the balance sheet is affected by loan loss provisions. We noticed that many banks are struggling with the impact various support measures may have on IFRS 9 and how to apply these guidance that has come out so far. Dick, can you please share some insights you have on this topic?
Yes, please. Thank you very much. Good morning, everyone. As a banking partner in the accounting advisory team, I've been indeed quite busy in the past few weeks helping and advising clients in dealing with the accounting implications of COVID-19. As Henning pointed out, there has been quite some activity at the regulatory front as well, also as regards to financial reporting and the application of IFRS 9. Systemic relevant banks have received letters from the ECB, and public statements were made by the ECB and ESMA in joint effort on the application and interpretation of IFRS 9. Also, the IASB, the standard setter, issued guidance, all in response to COVID-19 and how this is affecting the financial reporting of banks. In the next 10 minutes or so, I would like to take you through the main financial reporting topics for banks with an emphasis on the accounting for loan loss provisions. It is needless to say that COVID-19 as a shock is clearly exposing banks to unexpected losses. This literally means that banks will not have existing provisioning in place under the expected credit loss provisions. Now, in the midst of the crisis, banks need to find their way in getting the accounting for loan losses right. This will not be an easy task, given all the uncertainties we're facing. The IFRS 9 expected credit loss model works in a way that an economic shock, such as COVID-19, could lead to excessive procyclicality. Let me explain this. First of all, provisions are now to be taken for expected losses in a world that suddenly foresees economic downturn, which will lead to higher provisions. This is aggravated by the mechanism what is called staging. You may know that under IFRS 9, all loans and advances carry an expected credit loss provision as from the first day that the loan is recognized in the balance sheet. This provision is based on expected losses for 12 months only. IFRS, however, prescribes that this 12 months provision should be increased to what is called lifetime expected credit loss, as and when there has been a significant increase in credit risk since the initial recognition of the loan. This process of increasing the level of provisioning is called staging. One can imagine that the current sharp downturn in the economy and negative forecasts are likely to trigger this staging for a large number of loans. This could lead to substantial additions to provisions, especially for loans with a longer duration. Next to the impact of staging, banking also need to update their macroeconomic forecasts, at least with an updated downturn scenario, a scenario which will look worse as compared to the pre-COVID-19 scenarios. Also, the relative weighting of scenarios may need updating, as it is likely that more emphasis should be given to the downturn scenario. The adjusted weighted average macroeconomic forecast is therefore also likely to lead to additional provisions. So apart from the impact of the economic downturn on the credit quality of loans, which already in itself will lead to higher provisions, banks will need to absorb the additional impact of staging and of worsening economic scenarios. Last week, the largest US banks reported excessive provision increases. Bear in mind that this was the first time that these banks needed to report expected credit losses under the US CECL approach. This approach is similar to IFRS 9, however excludes the impact of staging, as all losses are lifetime expected credit losses. As mentioned, there has been quite some activity from the regulators and the ECB in coming up with guidance on the application of IFRS 9. Reason for them to articulate how to approach IFRS 9 in the current environment is to prevent for needlessly excessive provisioning with unwanted procyclicality. However, just to be clear, what Henning also already articulated is that IFRS 9 has not been changed. It has not been relieved nor relaxed whatsoever, regardless what certain media suggest. Both ESMA and the ECB gave guidance for the application and interpretation and highlighted a number of areas that particularly need attention. For example, how to deal with the impact of government support and how to perform economic forecasting. The IASB, on top of that, made a statement saying that banks should not apply their existing ECL methodology too mechanically. We see all these statements as a call to the sector to give due consideration to the impact of current extreme market circumstances in applying IFRS 9 as a principle-based standard. That takes me to my next slide, where I've included a number of focus areas. The first one is about the existing expected credit loss models. One could argue whether existing models are still fit for purpose, as these were built and calibrated against a very different economic reality as compared to what we're currently facing. As an example, banks may be using the same ECL models for groups of corporate exposures for which in the past there was a high correlation of PD behavior for all sectors combined with one single group. This, however, may not be the case anymore, as we may now observe divergence between sector performances. If we, for example, look at the performance of sectors such as the airline industry and the oil and gas sector, and compare that to sectors like supermarkets and telecoms, it may really lead to the conclusion that existing grouping need to be revisited. Another area of attention are the stage 3 provisions, i.e. the provisions against defaulted exposures. First and foremost, banks should reassess whether the recovery values calculated pre-COVID-19 are still appropriate. Asking the question is, I believe, already knowing the answer. The same is also applicable to collateral values, especially relevant when foreclosure is planned. And what about the PD and staging assessment? Are these still effective? Is the staging mechanism working? As it is often a relative PD assessment, it is important that the data used is sufficiently accurate and properly reflecting the current credit quality of exposures. Obviously, there may be more elements in the ECL process and the behavior of models which may not be effective anymore. We therefore see banks to make post-model adjustments and build model overlays to cope with all these changes. This will not be an easy task, but the review is clearly inevitable. Another topic of attention is the impact of government support measures. It is important to assess the impact of government support measures, both for economic forecast as well as for individual client and sector exposures. This is also an area where the ECB and ESMA asked attention for. Governments have put in place support packages for various sectors and individual companies that have been hit hard. They may have provided cash to individual borrowers, which obviously may lead to a reduction in the risk of the borrower to default or the amount of loss if a default would occur. Such support measures are therefore relevant to estimating PDs and exposures at defaults and may serve to reduce the number of exposures suffering an increase in credit risk. Apart from an analysis at individual exposure level, the provision of government support may also contribute positively to overall macroeconomic conditions by improving business confidence and reduced forced liquidations. Obviously, this requires an assessment of the nature of the support, the duration, qualifying criteria, and of course, the availability of funds. Another area of attention is the impact of payment holidays. What we've seen happening is that banks provide concessions on borrowing terms, such as payment holidays, but also relaxation of covenants or credit extensions. We see different schemes across the sector where banks offer forgiveness of interest for delayed amounts and hence incur a modification loss, whereas other banks continue to accrue interest on amounts deferred, which may not lead to losses. Banks need to assess what those concessions mean for the accounting. First of all, changes to contractual terms could lead to a so-called substantial modification. This will require derecognition of the loan and recognition of a new loan at current fair value, which will obviously have P&L impact. Where the bank provides only temporary payment relief and the net present value of the loan is not significantly affected, the modification is not likely to be considered substantial. In that case, the loan stays on the balance sheet and the fair value impact on P&L may be insignificant. Another element to consider in this regard is whether the extension of payment holidays is an indicator for a significant increase in credit risk or not. For that purpose, it is key to distinguish between situations where the payment holiday provides relief from short-term liquidity constraints for clients only, and that for the rest, those clients are in good shape, versus situations where clients are not in good shape anymore, where there is indeed a significant increase in credit risk. This will then trigger staging and additional provisioning. One of the more complex areas of the impairment assessment is the need to incorporate forward-looking information, and in particular to consider the impact of multiple forward-looking economic scenarios, as mentioned before. Those scenarios need to be incorporated in the expected credit loss models using economic indicators to which the credit risk of loans are most sensitive. Indicators such as expected changes in future unemployment rates and GDP growth are often used as critical economic parameters for this purpose. As of today, we are confronted with significant uncertainty about the depth and duration of the crisis. This means that forecast economic scenarios may vary significantly. One thing is certain though, which is that pre-COVID-19 scenarios need updating, as the world has changed and economic downturn is inevitable. The ECB has mentioned that banks should exercise an informed judgment to update their projections to reflect both the lockdowns and the severe social distancing restrictions imposed on the various economies, as well as the government support measures announced and implemented across countries. Judgment is also required about the potential rebound of the economy to the long-term trend. Interesting to mention is that the ECB would not object to any judgment that this rebound might occur within 2020, given the current level of uncertainty. we recommend clients for the Dutch environment to also look into the 4 CPB scenarios as presented late March, coping with the COVID-19 situation already. These scenarios can serve as an anchor for the forecasting process. Obviously, it is key that banks give due consideration to the impact of economic scenarios used and provide sufficient disclosure in their financial statements. That takes me to the final point of my presentation, which is disclosures. As you know, IFRS contains comprehensive disclosure requirements in respect of the risks arising from the use of financial instruments, such as key judgments made, key assumptions applied, and changes therein over time, as well as disclosure of estimation uncertainties. The ESMA has stipulated that disclosures should enable users of financial statements to evaluate the recorded ECL and to understand the assumptions and judgments made in their estimate. This includes, for example, judgment made on how and the extent to which the effect of COVID-19 and related support measures have been factored into the assessment of significant increase in credit risk and expected credit loss provisions. I think this is especially also relevant for upcoming interim financial statements, such as Q1 interims and half-year interim financials. That takes me to the end of my presentation, and I'm happy to hand over the microphone back to Ferdinand.
Thanks, Dick. That was very comprehensive indeed. Now, at the end of my introduction, I mentioned that we noticed a shift by banks to start preparing for a return to business as usual in the last few weeks. Leonard, can you, when you look at what's going on with the larger institutions, what do you think will be driving the agenda in a hopefully soon post-COVID-19 era?
Thank you, Ferdinand. Let me close by providing a few considerations on themes in banking post-COVID-19. Can move to the next slide. That would be great. Yes. So this is by no means a complete list, so happy to discuss further. We distinguish at least the following 5 key themes. The first key theme is refreshing business continuity and transitioning to operational resilience. Banks will have to recognize and embed the best practices they have developed during the crisis, both in terms of performing in the new normal and being resilient in a future crisis. Examples to do so are investing in home working technologies and connectivity, and revisit employee experience design based on the new normal and employment of work. Other examples advance the ability to model and predict consumer behavior, especially in times of uncertainty and disruption, and apply lessons learned during the pandemic to adjust the operating model, for example, in the IT area. The second key theme is a clear focus on balance sheet, capital optimization, non-performing exposure treatment, and potential future extension of payment holidays, already discussed by Dick. Due to the additional influx of loans, the asset side of the bank's balance sheet is currently increasing rapidly. Given the expected economic downturn, there is a risk of a rising share of non-performing exposures. What will the bank balance sheet look like? Which type of products does a bank want to push? In which sectors and geographical areas? And how does this influence the bank's credit models? These are questions banks have to start asking themselves. Some banks are already starting to prepare plans to shift workforce into recoveries and non-performing exposure management. The third topic, banks should be doubling down on transformation. As the coronavirus is forcing banks to change the way they interact with customers, the current situation could lead to an acceleration of permanent use of digital channels, rapidly speeding up digital transformation processes. Banks might consider intensifying the reshaping and density of their branch network. Digital transformation will also spur transformation in other fields. If banks invest in vast, high-quality innovation, they can come out more successful than others. The fourth topic, banks should place a focus on clients and growth. Banks need to review the way in which customer needs and behaviors will alter and act accordingly. This includes reviewing your product and service portfolio, assessing the implications of sustained demand disruption across markets, customer segments, products and services, and giving thought to post-crisis commercial arrangements, including sale, distribution, and marketing strategies, reflecting changes in customer demand and behaviors. Banks can re-engineer customer journeys and processes to meet the altered needs and behaviors impacted by the crisis, and also the potential upcoming structural reforms. For example, let's consider what the present crisis will do to the integration in the post-COVID-19 European banking landscape. On the one hand, the corona crisis has led to a retrenchment within borders. In response to the crisis, national governments have been in the lead in taking measures to tackle the emerging crisis in their countries, with little coordination from the European Union. On the other hand, the pending post-crisis evaluation of current events may very well lead to the conclusion that in the future, more European coordination is necessary. Like the last crisis, this crisis could spur structural reforms that significantly increase European integration, impacting the European banking sector and its business opportunities. And this brings me to my final point. Doing this all, banks should protect their workforce. At this very moment, banks are adjusting the way their workforce operates. Question is, which of these measures should they operationalize in a more structural way? In the more distant future, which capabilities will be required? And in which areas of the bank are they needed most? These are some considerations on the challenges and opportunities that banks will face after the crisis. I will be happy to discuss these further and provide more detail. Back to you, Ferdinand. Thanks.
Thanks a lot, Leonard. Well, that concludes our outbound part of the webcast. I've seen a lot of questions coming in, but perhaps in order to kind of keep a mindful eye on time, I would like to ask Joost Lensen, one of our regulatory consulting experts, to have one of the questions for each of the presenters, so that we can stay within the time frame that we have indicated. Joost?
Yeah, of course. Thank you, Ferdinand. And so I have a question to you, Henning, and it's related both to risk-weighted assets as well as IFRS 9. So Dick, also feel free to jump in if necessary. It seems that a lot of banks in Europe are struggling with the pro-cyclicality in both in credit risk-weighted assets and also in IFRS 9. And you and also Dick on IFRS 9 have indicated that credit assessments have to continue. So CRR, IFRS 9, they still apply. What would be the key recommendations that you have for banks to apply right now?
Thanks very much. Very good question. And indeed, that is something, that banks are looking at the moment. Our recommendations are, well, first of all, the portfolios should be analyzed and stratified in a way to identify which are the countries, which are the industries that are going to be affected most by downgradings and by potentially even a significant increase in credit risk. So really go through the portfolio, identify those sectors of the industries, countries that are hit most. Second, review the internal guidelines, processes, and procedures to identify those where automated approaches or current approaches in general should be changed to reflect COVID-19. And last but not least, also very important, manage capacities, activate resources, and commence with the credit updates and to make sure that the credit assessment is most actual. And bear in mind in all these activities that in a couple of months, potentially years, things that we are doing at the moment will be tested. There will be people looking into the mirror, looking at decisions taken in these turbulent times, and that will be reviewed. So therefore, it's good to be well prepared to take the right decisions today, take the right priorities, and document what you are deciding for which reasons.
Thank you very much, Henning. That is very helpful. I also have a question has come in that I'd like to relate to Dick. So you mentioned the reporting for some banks already on the Q1 closing. Do you have any examples on Dutch banks, how they are coping with specifically these economic scenarios for their closing?
Yes, indeed. Banks need to prepare their for a FinRep for Q1, where IFRS is the basis starting with. There are also some banks, obviously, that will prepare condensed interim financial statements under IFRS, and obviously there will be press releases. So IFRS is fully applicable for Q1. The response, what we've seen so far is that most banks start with their existing scenarios and are building overlays or make adjustments to these scenarios. I've seen one bank who takes the CPB scenario, scenario 2, which is a more than incidental downturn, as being the most likely scenario. We do not see banks that assume a so-called V-shaped scenario, which is sharp downturn followed by a sharp U-turn. But yes, indeed, U-shaped scenarios or extended L-shaped scenarios, those are being considered. But as a starting point, existing scenarios are taken and there are a topside adjustment made to reflect the current uncertainties. Most important, obviously, will be the disclosure on what has been done and also the disclosure on sensitivities, which will then result in meaningful financial reports.
Thanks a lot, Dick. And I think that's very useful. And also for Leonard, a question related to, let's say, short-term measures. I think you and also Henning have mentioned that focusing on business continuity planning is a key area for banks right now. But do you also see first steps for banks moving towards operational resilience? Are there already some first best practices you can share with the audience?
No, thank you for the question, and indeed quite relevant. Yes, I think banks are in general quite used to business continuity planning already and executing on those. What you see is that operational resilience goes really beyond doing business continuity properly. It means identifying people, data, systems, processes, and the like, and really testing for resilience on those. And the key distinction there, I think it might. So what you see is that the larger international banks that were, around the globe, subject to also US and UK regulation, they are more used to dealing with operational resilience as well from a regulatory point of view. So you have some consultation papers in Europe as well. It's called digital operational resilience. So the topic operational resilience is getting more and more traction. It very much goes beyond business continuity. I hope that that clarifies the answer. Maybe just as a closing remark. So you do see that in general, larger banks are more responsive to onboard this topic as of now. And then our experience has also been that they have been better in moving their workforce to work remotely than some of the smaller banks up to now. So I hope this clarifies the question. Thanks.
Thanks a lot, Leonard. And well, as Ferdinand had already mentioned, in the light of time, I'd like to hand back to Ferdinand.
Thanks, Joost. Thank you for kind of moderating the questions. I hope my colleagues and I have been able to provide you with some context or insights that will help you navigate through this crisis. Banks have a lot at stake in this crisis. Instead of being the problem, banks are actively trying to be part of the solution this time around. Handling this crisis in the right way could help restoring public trust in the sector that has long been missing. But expectations are high and maybe even unreasonable, so the situation could easily result in reputational damage. Responding in a way that meets expectations of the general public and also meets the compliance requirements that are there for a reason will be a very big balancing act. Obviously, this requires a lot of your organizations, and I wish you a lot of success in dealing with these many challenges that are ahead. Finally, I would like to thank the experts for their input and for you attending this call. There will be more webcasts to come, so please keep an eye on our website and social media, such as LinkedIn. And of course, feel free to reach out to all of the experts that were present in the call today or your contacts at KPMG. Thank you very much for joining today. Please take care and stay safe.